this is the stock-based compensation is in orange. The revenue of SOFI is in blue, and then the line at the top is the stock-based compensation as a percentage of revenue. So what I want to kind of focus in on here is basically, so they came public in second quarter of 2021, and then starting in basically fourth quarter of 2021 and all the way through the rest of it, they've had between 77 and $80 million of SBC. So that's been pretty consistent, right? And the way that breaks down is about 1/3 of that, so about 25 to 30 million, is from the performance stock units, and about 50 million of it is from the restricted stock units. So to kind of back up, so restricted stock units vest over time, so they're given to you. So they're given to employees, and the only requirement that those employees have to fulfill in order to be granted those shares is time at the company. So if they're still active when those shares are vesting, then they'll receive those stock-based units. Performance stock units have other performance metrics that are associated with them. And the important part and Tevis covered this also in one of his videos that he did earlier this week, but for the PSUs, the performance stock units, they are tied to the stock price, to SOFI's stock price. And so the way that they gave them, so they gave some of them to Anthony Noto in second quarter of 21, and then a bunch more to the rest of the executive team and the rest of the employees at SOFI in third quarter of 2021. And the restrictions on those are that the stock price has to get to $25 in order for them to get 1/3 of it, to $35 for them to get the second third, and for them to get 100%. So they get 33% of those PSUs granted to them or awarded to them. If the stock price hits $25, they get 2/3. So the next 1/3 vests or gets awarded if the stock price hits 35, and then the final third gets awarded if it hits $45. And that target, so that stock price target, has to be hit before June 1st, 2026. So in the next 3 years, basically, the stock has to either go, in order for them to get all of it, the stock would have to almost 10x from where it's at right now, right? In order for them to get even any of it at all, we have to trade for on an average for 90 days. So a 90-day average, we have to trade above $25 a share.
So 5x.
Yeah, so to summarize this, so for them to get at least 1/3 of these RSUs, we have to at least 5x PSUs. We have to 5x from here for at least 90 days. And for them to get all of it, we have to at least 10x. Now, Chris, in your research, is this something that most companies have as a plan for their top executives as an incentive, or is this unique to SOFI?
So it's not unique to SOFI. The breakdown of RSUs and PSUs and how they structure everything is really unique to each individual company, right? But in general, like this is how companies do SBC do it, right? Like for example, I know that Palantir, you're really into Palantir, and they've been criticized heavily for SBC in the past, but I personally don't know the breakdown on how many of theirs vest just over time versus different stock price versus, there's other targets that you can have for performance stock units too, right? So it could be like an EBITDA target, or it could be a GAAP earnings target, or it could just be a revenue target. And so it just depends on the company.
There was one really interesting piece in Chris's article that I sort of want to flag because I think it's like the thesis of the entire bear case, which is that, so RSUs, they're given over time. And if a new employee starts at SOFI like tomorrow, they would, after a cliff period, so generally like a year gap, they would go into that vesting. So 4 years, or 4 years is standard for most companies. And so in the future, SOFI would continue to give RSUs, which naturally vest over time, but the performance-based units, Chris was mentioning in his article, they're likely not to return. And so that, with the combination of the stock with the revenue continuously going up and the total SBC offered going down, as a percentage of revenue, it's going to come down very quickly over the next couple of years, number one. And then number two, the thing that surprised me very much was the massive variance in terms of the PSU payouts, if it hit or if it didn't hit. I think, Chris, you had a chart with all the major executives at each tranche, what that payout would be. And so if, let's say, SOFI hit $45 by 2026, Noto would be looking at, almost 300 million. And if that doesn't hit and all of those PSUs essentially expire worthless then the actual, if you break it down per year, the amount lost to his net worth in general, like that opportunity cost, would be absolutely massive. And so it's a gigantic risk for a lot of these executives because a lot of their compensation is PSUs. I'm sure, Chris, you can fill in a lot of the gaps because that was super high summary.
Yeah, I think basically the idea, and B-dubs, I'll get you to your comment and your question in a second. But the basic idea behind this table is that executive incentives are really aligned with investor incentives, because like if the stock price gets to $45 before 2026, that's worth $300 million to Anthony Noto, right? Like that's a huge number. And 37 million to Crystal Point and 34 million to Derek White, right? Who's the CEO of Galileo. So the other thing is that there's everyday employees actually got more than half of the PSUs. So there were 23 million PSUs that were granted total. 13 million of those went to rank and file employees, not to the executive team. So like 9 million went to the executive team, right? Which is a lot. But more than half of them went to normal employees. So there's lots of employees at SOFI who have this exact same incentive and will benefit if investors benefit. So and if you go back to the SBC, so about $80 million right now of that, like 30 million is paying just for these PSUs. And so for the last year and a half, every single quarter, we've been dragged down by $30 million every single quarter on our bottom line. So that hits gap income, right? It ends up being negative gap income that does absolutely nothing if we don't get above $25 in 3 years, if the share price doesn't get up there. So SoFi, like this is why like people will talk about how gap is the end all be all, and it is. Like gap is really important, right? It allows apples to apples comparison. It allows for transparency in accounting. Like there's lots of things that are really, really important, and there's like it's a necessary thing. But if you don't fully understand it, you don't realize that like $30 million every quarter is going to something that's going to cause zero dilution for shareholders and going to actually cost the company no cash or anything, in like no real money. Like it's just monopoly money that is on a spreadsheet somewhere. But it's $30 million every single quarter that's dragging on their bottom line that only is actually worth something if they get to $25 a share. Right. And so I just want people to be aware of these things so that they can have the nuance and the context to be able to interpret the earnings correctly.
So it's also like they're not just giving out stock-based comp just to make their employees feel good. The SoFi understands that this SBC that's hurting their gap profitability right now only matters if they can hit 25, which will make the options even worth anything in the SBC that they're giving. Because if the price doesn't go up, the stock-based compensation is worthless.
Right. And to be clear, 50 million, which is, well over half, is in RSUs that as long as people stay with the company will vest. Right. But even those are being expensed, like the executive RSUs. So they got this bonus, and it's in this same document. Let's see if I can find it real quick. I think it was just right up here. So they got a bunch of PSUs, right? So you can, if I zoom in, you can probably see it a little bit better. But they got a bunch of PSUs. This covers all the details, right? But they also got a bunch of RSUs. But if you look at the fair value of those RSUs versus the shares, the fair value for those shares are all up in like the $20 per share range. And these RSUs are still vesting now, and they're still being expensed now. So the shares that they're getting right now, a portion of them are still being expensed as if the stock price was still like $20 a share. And so like you can see again, and that's the proper way to do it with gap earnings, and to make sure that you're in line with everything. But the point is that like a lot of people just don't understand. They see this SBC and they think, oh, holy crap, it's 20% of revenue that they're just giving out in stock. And the point of my argument isn't to say like what's necessarily good or what's bad, but more to just bring clarity to the conversation, right? So that people actually understand and can have an intelligent conversation regarding SBC, rather than these people who get on Twitter and say, like the people who get on Twitter and say, he's making 3 times as much as the CEO of JP Morgan Chase, and that's ridiculous. So when they say that, they're talking about on the 10K, it talks about how that he earned, quote unquote, $100 million in 2021. But 94 million of that, which you can see on your screen right here, so 94 million of that what is totally I clicked on the wrong thing. There we go. So 94 million of that is in PSUs, right? So if we don't get to $25 a share before 2026, he actually got $0 from that $94 million that was reported as income, right? And so I just want to bring clarity to the conversation more than anything else. And there's a ton of detail, and there's no way we can get on into all the detail during this SoFi Weekly, but
like, guys,
anyway,
just look at one more time, because the other executives have a fairly even RSU PSU split, but Anthony Noto's split of performance-based units to the normal time vesting, where he only has to stay with the company for a certain period of time, is absolutely insane. Like this 100 million, like that will all disappear if the targets are not hit. And so he very, 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 very much more so than every other executive has skin in the game because of the disproportionate weighting in performance units as opposed to restricted ones.
And then think about how influential it is whenever he's purchasing shares on top of that with his own money. Like if he were to just work on the stock alone, he would already have so much skin in the game, but he's also doubling it up to also try to get that reward with his own money. I'd probably say like the only thing is like we don't want these shares to not get vested. We want them to have this money. You look at Tesla, for example, is probably the biggest example that I could think of, where Elon Musk had massive targets to hit around 2019 and then into COVID, where if he were to hit all of those targets, he would become the richest man in the world. I remember talking to my brother about this, and he goes, "Oh, no, that can't be true." And then look what happened, right? So he hit these insane targets. They held for, I think it was 60 days. And then he ended up actually, vesting those shares. And then obviously he gets rewarded. And because the stock is, 10 or 20x throughout that time, no one complains during that time because they are also getting rich during that time frame.
Chris, real quick, in your article, you say that there is until 2030 a limit that SoFi can dilute shareholders. Do you mind talking about that?
Yeah. So actually, everybody voted on this who's a shareholder. If you did vote in July of 2021, or sorry, 2022, it was they amended the stock-based compensation plan. That was one of the things that we voted on, along with the reverse split and everything else. Well, not the reverse split, the ability for the board to do, and the approval for them to have the power to do a reverse split. Anyway, part of that document that you can find, it's an SEC filing, says that the maximum amount that SoFi can award in compensation every single year is 5% of the total outstanding shares on December 31st of the year before. And so the idea is there is actually a cap. So you'll read ridiculous things, and there's even articles on Seeking Alpha where one of the authors says, they're gonna dilute you 25% this year. That's impossible. It's literally impossible to do with stock-based compensation. Now, if they did two Technisys size acquisitions and all the SBC they possibly could in 1 year, then that's possible. But that's ridiculous and isn't going to happen, right? But the maximum that they can give out in dilution is 5% per year. And the other thing is that it won't ever actually be 5% because part of those things, there's churn at any company, right? The only way that it would be 5% is if every employee they gave SBC to stayed on through the entirety of vesting all of their shares, which doesn't happen. So to date, about 1/3 of the RSUs that they've granted haven't been awarded. They've been forfeited because people move on and go to different opportunities and other reasons, right? And so approximately, if you go based on empirical evidence, we're probably looking at about 2.2% dilution per year. I think it's probably going to be somewhere closer to 2.8 to 3%, at least in the next few years, which isn't nothing, right? That investors should be aware that dilution is happening, and that it is a risk of holding this stock, is that you will be diluted because they do pay their employees through stock-based compensation. It's happening. It's important. You should understand it. The point is, though, if you're growing your revenue 50% and you're tripling your EBITDA, and by this time next year we'll be talking about GAAP profitability, which is what I think will happen, right? Like the question isn't like dilution's important to realize, but if you're paying 2%, 2.8% dilution in order to get 50% growth, that seems like a reasonable investment to me, which is why I'm continuing to add to my position, right? Like I'm DCAing into SoFi every single week because I think that the value proposition and the growth far outpaces, you know, the dilution, right? If we only get 2.8% return on this over the next 10 years, it's because of something else, right? It's not because it's because the growth broke, right? It's not necessarily because of dilution or SPC.